Okay, so you want to own a private prison. Sign a contract with the government, fill the beds, watch the profit come in. But here is the part nobody talks about. A private prison is the only business in the world where your profit depends entirely on one thing: keeping human beings locked up. And the government will literally pay you a penalty if crime goes down. That is the deal. Let's get into it. In the 1970s, the United States incarcerated roughly 200,000 people. By 1990, that number had exploded past 700,000. States were hemorrhaging money, running out of space, and politically terrified of being seen as soft on crime. Someone had to build more prisons, and a few very sharp businessmen raised their hands and said, "We will do it cheaper." That's how CoreCivic, originally called Corrections Corporation of America, was born in 1983 in Tennessee. GEO Group followed a year later in Florida. Between them, they now control over 70% of the entire American private prison and detention market. So let us start where it always starts: the price tag. You have three realistic ways into this business. The first is design, build, and operate. You finance the construction, build the facility to government specifications, and then contract with a state or federal agency to fill it with inmates. You own the building, you run the operation. All the risk and all the upside is yours. The second model is own and lease. You build the prison, but instead of running it yourself, you lease the entire facility to a government agency that operates it with their own staff. You become a specialized landlord, collecting lease payments every month. CoreCivic does this extensively. The company owns roughly 17 million square feet of correctional real estate across the United States. It is essentially a real estate investment trust, but instead of shopping malls, the tenants are state prison systems. The third model is operate only. The government owns the building. You just run it under a management contract. Less capital required, but also thinner margins and less control. Now, the actual money. How does cash flow inside a private prison? The engine is called the per diem rate. The government pays you a fixed amount for every occupied bed, every single day. Rates vary by state, security level, and contract type. But on average, you are looking at somewhere between $50 and $100 per inmate per day. ICE immigration detention contracts can push that figure even higher. Take Ohio as a live example. CoreCivic's contracts with the state lock in a per diem of around $49 to $50 per bed per day, and the state guarantees payment for 95% occupancy. That produces a minimum daily payment to the operator of over $127,000, whether those beds are full or not. Over a year, that is more than $46 million, floor guaranteed. At an ICE immigration detention center with a $65 to $90 per diem, the same math on 1,000 beds gives you $24 to $33 million in annual revenue. Before you have done anything clever, before you have cut a single cost. And this brings us to the strangest clause in American business: the lockup quota. A 2013 analysis of 62 private prison contracts found that roughly 65% of them contained occupancy guarantees. The most common threshold was 90%. Several contracts required 95 to 100% occupancy. Here's what that actually means. If the state incarcerates fewer people than the contract requires, it still owes the company money for the empty beds. The industry calls the penalty payment a low-crime tax. Colorado paid millions in penalties to private operators because crime fell and the state did not need the contracted beds anymore. The contract did not care. Arizona, Louisiana, Oklahoma, Virginia all have had deals forcing the state to pay for cages whether or not there is anyone to put inside them. For the owner, this is extraordinary. A bakery does not get paid for bread it did not bake. A hotel does not bill guests who never checked in. A private prison owner does. The guaranteed revenue floor is baked directly into the contract. Now let's look at what the building actually costs to build and to run, because this is where most people who think this sounds easy get destroyed. Construction costs for a modern medium security prison in the United States run between $125,000 and $370,000 per bed, depending on size and design. A 1,000-bed facility lands you between $125 million and $370 million before you have hired a single guard. A 2,500-bed facility, a realistic operating size for a major CoreCivic or GEO campus, can cost $400 million to $750 million to build from scratch. Then the daily overhead begins. Staffing is the biggest line item. A functioning 1,000-bed prison needs correctional officers, medical staff, administrative personnel, security supervisors, and maintenance crews running around the clock, 365 days a year. Private operators cut here aggressively. They pay guards less than state employees, run leaner shift schedules, and carry higher turnover as a result. That saves money. It also creates problems. Then there is food, utilities, healthcare, liability insurance, facility maintenance, compliance audits, and the legal exposure that comes from running a building full of people with a lot of time and motivation to sue you. CoreCivic's second quarter of 2025 results give you a live snapshot of what this looks like at scale. Revenue of $538 million for the quarter. Net income of $38.5 million. That's roughly a 7% net margin. Adjusted EBITDA came in at $103 million, which reflects the high depreciation load on all that correctional real estate. So with guaranteed contracts, occupancy floors, and government money, why does anyone in this business ever lose? Two failure modes show up again and again. The first is politics. In January 2021, President Biden signed an executive order telling the Department of Justice to stop renewing contracts with private prisons. Stock prices for CoreCivic and GEO Group collapsed overnight. Neither company knew if their contracts would be renewed. Neither company controlled the decision. A single signature wiped hundreds of millions of dollars off their market caps. The order never touched ICE detention. Both companies survived by pivoting harder toward immigration. And in 2025, the order was formally rescinded. But the lesson is permanent. The entire revenue model depends on a government that wants to keep incarcerating people at scale. Change the administration, change the policy, and your guaranteed cash flow evaporates. The second failure mode is the contract that works too well on paper and collapses in practice. Ohio's Lake Erie Correctional Institution was sold to a private operator under a 20-year contract with a 90% occupancy quota. Cost-cutting followed, staffing levels dropped, and violence inside the facility increased. Crime in the surrounding community increased. The contract guaranteed payment. It did not guarantee that running the facility cheaply would be sustainable. Eventually, the situation drew investigations, press coverage, and political pressure that threatened the contract itself. The math looked great, but the operation was a complete disaster. The ICE boom is the new frontier, and it's currently the fastest growing part of this industry. By late 2021, roughly 79% of all ICE detainees were housed in private facilities. Recent figures put that closer to 90%. Under the current administration, ICE detention populations have hit record levels, and both CoreCivic and GEO are building new capacity as fast as they can sign contracts. GEO Group is projecting approximately $3 billion in revenue for 2026. Company leadership called 2025 its most successful year for new business wins in the company's history. The driver is almost entirely immigration detention. For an investor, this is where the growth is. Federal immigration contracts tend to carry higher per diem rates than state prison contracts. They also carry higher political risk. One change in enforcement priorities, and the pipeline reverses. Let's bring it to actual numbers. Two scenarios. Scenario 1. You're an investor group that builds a 1,000-bed immigration detention center under a 10-year ICE contract at $80 per diem and 90% occupancy. Annual revenue is approximately $26 million. Construction cost is $175 million. Annual operating cost is approximately $17 million. Net annual profit is roughly $9 million. Payback period is about 19 years. Not exciting on its own, but you own the real estate, the contract has escalators, and at year 10 you renegotiate from a position of leverage because ICE has nowhere else to put those people. Scenario 2. You're CoreCivic. You operate 65 facilities. Your portfolio produces over $2 billion in annual revenue. Your EBITDA is north of $400 million per year. The federal government is your anchor tenant. You don't just survive policy changes, you lobby against them, and you've been doing it successfully for 40 years. The individual investor and the institution are playing completely different games. One is building a real estate asset with a captive government tenant. The other is running a vertically integrated incarceration corporation with political infrastructure to match. If you found this interesting, like and subscribe for more.